real estate market. Now the finance evolution is there, right?
Right.
We are seeing a lot of players getting in this market, especially in the finance.
Right.
What would you say is Certus Capital USP that makes it stay ahead, or I would say stay ahead the game, or we stand apart from the rest of the competitors?
I mean, honestly, I think we are still young, so I wouldn't necessarily kind of claim that, we are the best or anything of that sort. I think what's different though is a lot of quality talent continues to sit in organizations. Many of those are serving only foreign capital, in the sense that most of these organizations, whether it is domestic organizations like Kotak, or whether it is international or foreign organizations like whether it is Blackstone or Brookfield and all that, most of the money that they're managing comes from foreign investors. These are pension funds, sovereign wealth funds, etc., etc. Indian investors actually haven't had much access to teams that come trained from these kind of organizations, right? And offer products which are available to domestic investors, right? So I have personally seen that the learning that we have gone through, because some of these organizations have had much longer history of investing into real estate than Indian real estate itself. Indian real estate investing history itself, which started in 2005. Global investing has been, so they have their best practices, which I think some of the things we have in our team, and we continue to do a lot of work with them. Like in 2021, there was a very large foreign investor which invested 1,000 crore into Embassy Group, and we were advising the investor on that. In 2022, three couple large investors and Loda Group created a large warehousing platform. We again advised one of the investors in that, right? So I think we continue to have that strength of being able to work with these global investors and then bring that expertise to products that are domestically available, right? So I think that's the thing that keeps us ahead. When we do these engagements, we get questioned, our thought process gets tested against that, which help us improve that process. We are very data driven, so we actually do a lot of internal in-house research around what the trends are, right? uh, so I think those are some of the things that I kind of believe will allow us to make good investments and get them to the right outcome and return.
So talking about data, we are seeing even technology has been,
Right.
hugely adopted now. We are
Right.
seeing digital transformation
Right.
happening in all the industries.
Yes.
As you mentioned, you are data driven. Ernest, me is on the Wiley platform, which is creating a seamless transactions happening. So, how technology are you using when it comes to Certus Capital to make your operation seamless?
Yes.
To make sure that, of course, the data security is also there.
Right.
How are you managing technology in that?
So we use data and technology in 2 3 different aspects, right? I mean, data, thankfully, is not just about us. It is about the availability of data for the real estate sector. That has improved a lot. Like 10 years back, there used to be no data services, right? RERA wasn't there, so there was no organized accumulation of data, right? So thankfully, over the last 10 years, what has changed is, one, there are a lot of data services which allow us to mine the right kind of data. And RERA actually is a great source where information about what is the situation of a project, how many units sold, etc., at project level, some of that is available. So thankfully, that data is available. Now it is for us to use, and so we have in-house models where we ensure that a lot of this data is kind of collated on a quarterly basis, right? That honestly anybody can do. It's not that we have created some kind of proprietary tech to analyze that data. It just is that we are a data aware organization. So we collect it, we analyze it, we have teams that do that, and then they disseminate across the organization, right? That's one. But when it came to earnest.me, so the whole idea was that this whole thing has to be very seamless and transparent. Today, the biggest complaints that you would hear of products that came out, people didn't know. I mean, they made a commitment, they didn't know where it went, what happened, what went wrong, and all that. So the whole idea was that, can we make it very transparent? So in that sense, we have created a technology or a base which allows us to present these things in a very seamless manner. The second thing that happens is just the whole process for an investor. In most alternative products, historically it has been cumbersome. Now, not only us, but a lot of other companies are also making it easier, but we are one of them. Uh, so the whole idea is that this whole process should be very easy for you. You should be able to log it on your mobile and do it. So the KYC is very simple. Looking at the information is very simple. Just one click will allow you to put in your request. Automatic forms will come to you. You will put in one OTP. You will get a signed transfer of paperwork, and then things just go right. And then whenever you want to look at what is happening, you have a whole dashboard where you know what is happening with your investment, what is happening with the underlying project. I think that's kind of, and there is a lot of work, like 2.5 years of work that has gone into in simplifying this and presenting it. So that's kind of what's
So your interface of Earnest is quite user friendly. That I understood.
yeah.
But as an investor, if I'm logging in, what kind of security are you providing for my data or for my particular portfolio? I would say, is there certain security measures that you have made sure that everyone's information, because as you mentioned
Yes.
and give an example, now we are seeing a lot of products which are being launched.
Right.
Later we get to know the investor or the people, the customer base or database has been shared
Right.
to third parties.
Right. Right.
How do you make sure that this doesn't happen
Right.
in your particular firm?
Right. So I think we have put safeguards on that because data accesses there to a very limited set of people within the team and all that stuff. And there are certain firewalls and all that our tech team has put in terms of so that an invasion cannot happen to a certain extent. And we are further improving on that, I must say, right? We also try and ensure that we are not taking too much. We don't take any personal or financial information and all that of our customers and all that, just the basic KYC information. So we only take information that is absolutely necessary from the perspective of executing these trades. So we don't unnecessarily create any info. We never sell anybody's data. Whatever is there is only for our own internal use. So I think those are some of the things that we're using. But I personally think we and industry in general still has a long way to go in terms of just making sure that these things keep becoming more and more robust.
Also, lastly, based on your journey, I want to know when you started Certus Capital, having the right talent, right team
Yeah.
is crucial, especially
100%.
when you were talking about how you had to change overnight.
Right.
Having that kind of adaptability to the market trends or the market changes is required.
Absolutely.
So, what kind of approach did you go through when you were hiring or you were forming a team? What were the basic criteria for you that you made sure that it aligns with the vision of the Certus Capital?
Right.
Were there any particular I would say requirement or checklist for the team that you made sure that these people should join in my entrepreneurial journey?
Yeah, no, I think team building is the most important thing, right? Is the most important thing. I have been lucky enough that I've been hiring teams since 2006. Because when I joined Morgan Stanley, I was just the second person to join in India. And the first person is actually my director of investments now, Sahil Shah, at Certus Capital, right? So we went through that process. In KKR, it was the same thing. I was hired, and then we built the whole team. I mean, the way we focus on building a team are driven by two, three basic things. One, first and foremost, the integrity has to be very, very high before technical competency. The second thing is, yes, we want people. It's an investing business, so you do need experience. So our team, I wouldn't say is very young. I think average age of our team will be having a work ex of about probably 14 to 15 years. Right. So we wanted to hire initially at least, and of course, as an organization it gets younger. But initially, you need people who have a lot of expertise. They've gone through 2, 3 cycles. They've seen it, and they have lived through it, both in high investing cycles, low investing cycle, managing investment from entry to exit, and all of that stuff, right? And honestly, because I've spent almost 20 plus years in this thing, all our hiring has been entirely through reference. So a lot of people are people who have worked with, we had been part of teams together in the past, or these are people who came from references of people we have worked with. So to give you an example, uh, Sahil, who is a director of investments, he and I were at Morgan Stanley together for 7 years. Vishal, who was a partner at Deloitte and joined us. We have closed 3 deals together when I was at KKR, and he was the advisor. So he runs the advisory business, right? Some of our other senior members either were directly known to me from the past or they came through reference. So actually, a lot of senior team does come from people who I knew and have had relationships. To me, that's very important. More than where we are going as a business, it is actually emerging as a place where a lot of people aspire to be because of the experience that they can get and the quality of team that exists. And then the younger team, I mean, we actually look for attitude more than technical skill set. We look for people being self-managed. So I think attitude, integrity, self-management, and of course, depending on how many years of experience you're buying. I mean, if I'm hiring 1 or 2 years, I don't actually care the person coming from real estate or investing or any kind of background. It's just their motivations and their hunger and their attitude. When you're hiring mid-level, they may not have done the exact same work, but some familiarity has to be there, and again, these attributes. So that's how we kind of try and build.
So in the current fiscal year, what would you say are the ongoing projects which are happening under Certus Capital,
Right.
and how do you envision the future of Certus Capital?
So I think the way we think of the future, and then that feeds into what we do today. So we are honestly very long-term focused. How 1 year goes by, plus or minus, is less important to us as long as the overall business is headed in the right direction. So what we really want to be is a real estate capital solutions provider. We are not a developer. We are not someone who is actively like kind of saying that we will go in and manage the project and all that stuff. We are going to work with developers who we like, who we trust, who have done good business in their past, and we are happy to sometimes support younger organizations. Even in KKR, I have done business with people who are not like having legacies of real estate, and those have been some of our best investments, in fact, right? The way we think about it is, can we be a capital solutions provider? So we have our own investing business and we have the advisory business. Between these two, we look at transactions which are as small as 50 crores. Two, we have concluded transactions which are 3,000 crores and upwards. So what it does for us are two things. One, as an organization, as I said, we are very knowledge and data driven. It provides us a lot of information. Like we worked on that one warehousing trade. Today, investing, we are mostly doing secure debt investing, by and large into the residential sector. But by doing that warehousing trade, we as a team are quite educated about what's going on in that sector. And it allows us to make a choice when to start investing our money into that space, right? So we have that space where some of the largest developers in this country are engaging with us for their own capital solutions. We may participate in that, but more importantly, we also have a lot of relationship that will allow us to create that capital solution. And on our own side, we choose the highest conviction themes, and that's what we are really bringing to the investors. Right now, that highest conviction theme is actually private credit into residential, and that's what we are doing, and that is what we are bringing through Earnest for now. And we may also do an AIF. That's kind of what we're contemplating. So as we go along, 4 5 years down the line, if a real estate company has a capital solution, is Certus Capital the first name that comes to their mind? I mean, that's what we want to be. And in that context, this year we are looking at doing maybe 700 800 crores through the Earnest platform, and maybe few large, maybe couple large transactions on the advisory side of a platform. So this is what's going on.
Okay. So thank you for sharing your journey and especially of how Certus Capital's origin story happened. Now let's shift our focus on the changing landscape of finance investment within real estate sector.
Right.
So as of now, the option seems limited. We have banks and we have your, NBFC,
Right.
each having certain kind of restrictions.
Right.
And then we have AIF, which has a limited pool. So, how do you perceive these dynamics evolving, and are there any innovative financing mechanisms that you believe could bridge over these gaps in the sector?
Right. So I think when you think of capital flows that happen into the real estate, I think broadly you can divide those capital flows into two categories. There are capital flows that has been happening towards acquisition of assets or supporting assets, right? Which is where your Brookfields, Blackstones, GICs of the world has been buying assets in India across the spectrum, whether it is office, whether it is retail to a certain extent, industrial warehouses. I think has been a massive theme over the last few years. Data centers is an emerging theme and all that. And I think this capital flow is fairly robust. A lot of capital is there, and it is mostly international, mostly global capital. And in this space, these guys participate very well, right? And now some of this has been also converted into REITs. We have now four REITs already. I mean, three on the office sector and most recently on the retail sector, which is the first retail REIT. So that thing is also there, and a lot of domestic capital participation we are starting to see in seen REITs. So that's one part of the capital, which to be honest, that we have no shortage of, which is a great thing. What it tells us is that global institutions see India as a long-term story, and they're willing to buy and hold long-term real estate assets in this country. Then there is other part of the capital requirement, which is for building real estate. You know, and especially in India, you have probably about 50 million square feet of annual office absorption. You have probably 40 to 50 million square feet of industrial and warehousing absorption right now. Maybe I don't know 5-6 million square feet of retail, but you have almost 350 to 400 million square feet of residential, and that is all development, right? And there has been limited capital to support that. You know, the largest of developers like Oberoi's of the world, of course, are very well banked and very well capitalized, but it's a fragmented industry, right? So there the capital has been limited. In between, there was a time when NBFCs were extremely aggressive. And in fact, there were a lot of mistakes that were made both on the asset side and on the liability side. Investments that were not so great that happened, and also some of the NBFCs were highly leveraged because they were mostly home loan players and they stepped into development financing, and it causes issues. And after that, RBI has also changed certain rules. So our NBFCs also become a little bit more restricted than what they could do pre 2018, right? So then what happens is that India, which is largely a developmental country as opposed to many Western countries, don't have enough capital to support their development, right? So I think to our mind today, AIFs are stepping into doing so. But what is really, really required is a much, much wider participation of domestic capital into this space, right? So, I mean, to us, what is probably the real trend to watch out for, or the trend as an industry to work towards, is how to democratize the access of this capital, and can we create kind of a debt capital market for the industry. I mean, we are trying to take some steps in that direction. We talked a little bit about earnest.me. I mean, at a fundamental level, it is creation of that capital market where you're increasing the transparency of what we are seeking that capital for. We are improving the ease with which that transaction can be done, and you're also increasing the confidence by providing very transparent information about after that investment has been made, right? So to us, yes, AIs will continue to play a major role, right? And domestic wealth, I mean, and we constantly read so much about the power of domestic wealth that is happening. How do we harness that in a more meaningful way for our sector is what I think is very, very important. And I think actually we will possibly talk about more, but SEBI is coming up with its own regulations. They have been doing a massive overhaul of the AIF regulations. They're coming up with regulations which relate to bond trading platforms and all that stuff. So all of that is very helpful. I'll do that. But to me, AIFs need to come out of the shadow of bad performance that has happened in the past and deliver a different story over the next 5 years. And we need to democratize access and create a debt capital markets for the sector. I think those are the two most important things to watch out for.
So as you said about Oberoi, in the light of the current scenario, what we are noticing is that the handful entities like Oberoi and DLF, they have access to the robust debt capital market in the real estate sector, and that results into significantly having a low cost of capital.
That's right.
So I want to understand that why in the current scenario we still have this limited, entities. Why we don't have a broader spectrum of having all the stakeholders
Yeah.
participate in this kind of scenario where they can also have this access of the lower capital cost of capital
Right.
in comparison to AIF that I have noticed gives higher capital. Right.
Right. No, you're right. I mean, it's a twofold problem, right? First of all, in India, bond markets are shallow. So 98% of bonds in India that are subscribed, and they're by and large subscribed by mutual funds and few institutional investors, they are AAA and AA.
Yeah.
So there isn't really a market below AAA and AA rated bonds. Now, as I mentioned, real estate sector is fairly fragmented. So many of these companies do not necessarily have that kind of a rating or can get that kind of a rating, right? But that doesn't mean that they are not doing good business. There are enough and more companies doing good business, and there's a secured thing, right? Also, the other problem that is there is that most of our uh, bond markets are driven by mutual funds, which provide daily liquidity. So there is no ability for them to take true credit products. Like Franklin is a good example. I mean, their funds have ultimately returned most of the principal that they shuttered when they closed those schemes in 2020, and by now, I mean, very recently, they have paid most of their capital. But some of those papers could not have provided daily liquidity, and in tough environment it suddenly became even more difficult, right? So you actually need to do a bit of a market making here. You need to have some financial companies or organizations which are willing to put their stamp of approval in a way which will provide confidence to the investors to participate in that. And then it is probably at least a 10-year journey before a lot of organizations through that format then themselves become discovered. So if, let's say, take an example, okay, if there is an organization which worked, which issued its bonds, someone like us through earnest.me kind of worked with them to issue that, it got managed well. And then over a period of 7-8 years, they did 10 issuances of that nature, and each they were able to do a good job for their investors. By that time, they're discovered, right? So that's kind of and I think India just need to go through a lot of that landscape before that happens. But I think if they do so, they will be able to reduce their cost of capital for a lot of non-NBFC and non-bank use by at least 4 to 5%.
But don't you think, as you quoted about Franklin example, we have also seen that, of course, they've started paying out and everything. But don't you think it affects market sentiment it affects the investor sentiment, and it might even affect the way you're talking about the finance investment should be, more coming in, especially in the real estate domain. When it comes to real estate investment, don't you think the market or the investor will be more still feeling skeptical about the market?
100%. So that's exactly the point. I mean, a lot of investors will be very skeptical. And, like in debt mutual funds, when people look at a mutual fund, they almost treat it like an FD. You can go in today, you can take out tomorrow, you don't expect any capital loss whatsoever, and so on and so forth. But any credit product can actually have a capital loss. If your yields go up, the value of the fund will go down. The other thing is most credit products can't provide the same level of liquidity. So if you are a fund which is starting to see a lot of redemption pressure and you were a credit fund, you will not be able to honor these things. And that's exactly this whole episode of Franklin taught us. So to give you an example, when we have something on earnest.me, we're very clear with our investors. You should not invest unless you have the horizon of, let's say, a 3-year or a 2-year or a 3.5 year, whatever that paper is for. Because, as a sector, we are funding a project. If we are funding a project that has a life of 3 years, so my financial instrument on that should also have a similar life. Otherwise, there will be a mismatch. And therefore, that education needs to happen. So then when the investor has that education, he comes with that clear mindset, then these kind of accidents can be avoided. And that is what needs to happen over the next few years to build that confidence and education as to who this product is right for what kind of portfolio allocation, how people should think about it, and then grow from there.
So, as you quoted about Franklin, I want to understand your perspective when it comes to, the companies like which we recently saw, ICI Prudential, 360, one private equity fund, where they went. I want to understand what challenges these investors faced. Also, in case where underlying investment, remain unsolved even after AIF being expired, the delay in the payouts happened. What do you believe are the takeaways or the insights that investors also should keep in mind, and even the market should learn from these incidences?
Right. So I will talk more generically. I mean, I don't have a specific view on maybe these one or two companies per se, but in general, the point that you're making is correct that several real estate AIFs and outside of real estate also several other AIFs have run into problem in terms of they not liquidating their entire corpus by the time the fund term expired, right? And incidentally, in that context, even SEBI has now come up with regulation where if you do not fully liquidate your funds within 1 year of the expiry of the term, either you need to move them into a liquidation scheme or do in specie distribution, which means that whatever is the fund assets, you just give it to the investors in their investment ratio, right? And there are a certain set of things and all that. So historically, I think there are 2 3 issues around this thing. One is when the product is new, there is the experience of teams were less. Some products got created and they did not do as well as they were envisaged to do, right? And when you had an investment problem, then there wasn't really a proper market for exiting them. And also in the absence of this regulation, I mean, maybe not intentionally, but investment managers also may have just tried to keep prolonging the period with their desire to get the best possible value for those investments, right? But to be very honest, I think that may be a reasonable intent. But if as an investor you have put money with a certain term in mind, you really want the money to be returned within that term or thereabouts of that term. So I think with this regulatory change, now when people will do it, they know, okay, there is this kind of a deadline. And they will hopefully start working earlier. And even if that means that they have to just liquidate it, whatever is the market clearing price at that point in time, they do so. They do so. And in fact, don't get into this jam where they're trying to take 75% consent of investors, which is any which way the negative thing then, and then are in they're back against the wall, right? So point number one is the first line of defense is having good investment managers. Right? So it's like any other investment thing. If you do not end up doing a good job of that, or if the market is a bit early on, some mistakes will get made, people will learn from those mistakes and all that. So I do fundamentally believe that similar to the maturing of a real estate industry in itself, which got matured because of RERA coming in, because of demon happening, GST, plus just the cycle. So a lot of people, everybody thought that they could be developers. Like, they have decided they can't be. There has been a lot of clearance that has happened, right? And industry has become a bit more mature. Same is happening with the investment management industry also for real estate. A lot of people who were in the space, many have decided you need real expertise for it. So either you're developing that expertise or you're vacating the space. So that consolidation is happening there also. Or new firms are coming, including ourselves, where people have done it for donkey's years and now they are using the same expertise to create a new experience. So I think that's really is what going to change. And AIF as a regime, which also came in 2012, now it has also completed over a decade. So actually SEBI is completely overhauling that regulatory framework also, bringing in some of these disciplines, which will force people to make sure that exits are given, happen, whatever that means from an investment performance point of view. So I think a combination of these two things, hopefully the next few years will have a better experience.
But talking about AIF, I want to understand from you that now the SEBI has given a minimum threshold of 1 crore to begin
Right.
with, right? So won't this create a bit of, I won't say nuisance, but all kind of players coming in? The market sentiment again can again be affected based on who is running what kind of show. This kind of accessibility, do you think it's going to be an advantage or a disadvantage when it comes to real estate market?
No, see, I think the minimum threshold for AIF is 1 crore right now. And I think that is what it has always been, at 1 crore. In fact, there's a lot of talk about SEBI wanting to increase that threshold, right? And they've also come up with this concept of large value funds, which are extremely large value funds right now, where single investor has to be at least 70 crores and upwards. So I think in regulators' mind also, 1 crore is actually not a very high ceiling in today's context, right? And therefore, they are bringing in so much more regulation around AIFs, which wasn't the case earlier. So, to my mind, it actually increases the regulatory burden on the manager. It will force more serious players to be in this field. Also, the industry, after seeing through uh, the history, is likely to allocate money to people who are more credible, right? So, to my mind, I'm not too worried about the quality of managers jumping in diluting. In fact, my personal feeling is it should improve from here on. Also, it has SEBI has aligned certain other practices which related to distribution of AIFs, right? Because originally, like you can pay any kind of fees, and all of that was upfront. Now SEBI has mandated how much fees distributors can charge upfront, and it has to be. So that also brings in a bit more discipline in terms of it not being a crazily profitable product to distribute, and therefore avoid some bit of mis-selling.
True. And currently, how we are, you pointed out, the financial crisis which we are seeing,
Right.
or I would say the economy, how it's going for countries like US and UK. I want to know from your expert view, when we see in global countries these kind of scenarios happening, does it affect Certus Capital investors in a way, or do you keep that in mind what is happening in other countries and you uh, change the scenario accordingly, keeping in mind how it needs to adapt to what is happening in global market?
So, see, I think that's a good question. I mean, what happens globally certainly has an impact on how capital flows happen to India, right? There's no doubt about it, right? So, if the yields globally has gone up, right, India actually needs to provide a premium over the yields that are available in the US and let's say Europe and so on and so forth, right? So, if the yields there have gone up, they can actually make good return in their home country, so they start demanding more from India, or Indian transactions at similar yields look less attractive, right? So it regulates the flow, or it reduces the flow to that extent, and we've seen that happening. And in fact, one of the conclusion that I was talking about, why domestic capital is therefore important to be harnessed into the sector, is so that we are not heavily reliant on this capital, because then we are at the mercy of how things are happening there, even if things are happening well in India. So we certainly need foreign capital, and it is coming also. But at the same time, if we have twin engines of foreign and domestic capital, it's much better for the sector. We at Certus Capital for sure uh, are quite watchful of that. The very reason of creating Earnest.me was the recognition of the fact that just this foreign capital will not provide us all the solutions that the sector may need, right? So that's where I think we are creating this domestic engine in that sense. And to that extent, yes, I mean, we do need to be fairly vigilant about what are the interests of those capital, especially in some of the larger format deals that we do, where we do directly work with foreign capital, to be aware at where it will actually happen, where it won't happen, right? Because if we keep chasing something which is just very difficult to happen, then it will waste the time of the companies wanting that capital or the solution that they're looking for. We need to be vigilant, but at the same time, we need to keep trying and creating as much domestic solutions as are possibly there.